Alright, so today's bank is City Holding Company. It's based in West Virginia. It's a fairly average sized bank. It's got a little over $6 billion of assets and about 97 branches, and it spans West Virginia, Kentucky, and Virginia, and Ohio. If we look at the Yahoo Finance page, we can see over the past year it's just gone way up. I mean, it's been a really, really good performing stock. It went from about $90 a share all the way up to about $118 now. The past couple days have been awesome for bank stocks. So these guys have been enjoying that. So coming down here, we can see that the PE ratio is almost about 15 times. That's pretty high. We usually see somewhere around 10 times for most banks now. So 15 times pretty on the high side. You can see the market cap is about 1.7, and that's pretty much in the top of the average range of banks that are in our portfolio. So it had sort of an average total asset side, but the market price is a lot higher. So it seems like the bank is trading pretty expensive to its earnings as well as maybe to its net assets. Yeah, so we can see 2.48 price to book ratio. That's really, really high. We typically see somewhere around 1 times, right? So there's something about this bank that makes it really valuable to the market. Coming down to the return on assets, we can see almost a 2.2% return on assets. So that's about double what we normally see as well. Really good return on equity. So it's a really profitable, really good return bank. But it's also priced really expensively, it seems, just looking at this, right? So once we dig into things, we'll be able to know a little bit more about how it's so profitable and whether it makes sense to pay such a high price for those earnings. So now we're in the balance sheet. We've got about $318 million of cash. That's about 5% of the assets. That's about average for what we typically see. Investment securities, 1.3. It's about 21%. It's a little bit more than what we would typically see. So maybe a little more allocated towards securities as opposed to loans. We see that loans are about $4 billion, and so that's 65%. That's a little on the low side. So it does seem like they're a little more allocated towards securities than toward loans, and that would mean that more than likely they've got a little bit lower net interest income, or a little bit lower interest income than what we would see for a bank that's more averagely allocated towards securities and assets. So everything else seems really normal. A little bit more goodwill than what we would typically see, but not by a whole lot. So getting down into the liabilities, we can see non-interest-bearing deposits is about 1.4. It's about 24%. That's a little bit on the high side of the range that we would typically see for most banks. We usually see somewhere between 20-24%, something like that. So 24% is pretty good. We would prefer to have as much non-interest bearing deposits as we can have. So it's basically a free funding source, and in a lot of ways it earns fees for us. And then also the interest bearing deposits as well as the debt is a little bit on the low side of the percentage of liabilities that we would typically see. So they're a little more allocated toward non-interest bearing deposits, and also less allocated toward stuff like FHLB borrowings, which we would normally see at most banks, but there's not a whole lot of those. It's maybe only about 2.5% of the liabilities. So it seems like they're a little bit more allocated toward cheaper funding sources and generally no-cost funding sources, right? So that's fantastic. So that might lead us to believe that perhaps the interest expense might be a little bit lower than what we would see for most banks. So then the interest income being a little bit lower, but also interest expense being a little bit lower, so perhaps that would lead us to think that perhaps there's an average net interest income, right? So we'll see. We've got about 73 million of interest income here. That's about 5.13%. That's fairly average, maybe a little on the low side for this particular quarter, but definitely compared to last year, it's about an average yield. And then the yield on the loans, 59 million. That's about 5.78%, which is it's pretty average as well. So, securities 12. That's about 3.83%. It's actually a pretty good yield on the securities. So, it puts us sort of in an average amount of interest income, which is kind of what we expected, although the securities are yielding more than what we would have thought. So it's pretty good interest income, not bad. So the interest expense, 19 million, that's about 1.39% of assets. That's really, really low. I mean, we normally see something at least above 2. In some cases lately, we've seen a lot of 3% here. So with their liabilities only costing 1.39%, that's a fantastically cheap yield. And deposits, yeah, it's mostly in the deposits because deposits are yielding about 1.12%. So if we divide this 14 million by the deposits balance, it's about 1.12. So really, really cheap deposits, and actually cheaper than I would expect, just from a little bit higher non-interest bearing deposits, right? I mean, that's contributing, but somehow they've got really, really cheap interest bearing deposits. So hopefully we learn what's going on there, but that's maybe how they're making, the ratios in the Yahoo Finance show really good return on assets is perhaps due to cheaper deposits. Hopefully we learn a little bit more about that as well. So all that together gets us net interest income of about 54 million. That's about 3.45% of assets, and that's a really good net interest margin. I mean, we're usually looking for somewhere between 2.8 and 3.10. So they're having 3.5% is just, it's off the charts good. And I guess it's mostly due to having really cheap funding sources, and however they achieve that, I don't know yet. But so 17.9 non-interest income, that's about 20% of the revenue. That's really good. Typically see somewhere around 10 to 13%. So 20%, they're making really good money on ancillary services. So we've got trust and investment management fees, service charges, and then bank card revenues. They're doing really good on the non-interest income as well. And then the non-interest expense is about 36 million. That's about 39%. So that's cheaper than what we normally see as well. We typically see somewhere between 40 and 47. So they've really hit all marks here, where they've got really good net interest income, really good non-interest income, and really cheap non-interest expense. So all that together, after income taxes, gets us about 30 million of net income to the common shareholders, and that's about 1.88% return on assets, which is fantastic. It's basically double what we would see for most banks. So they're making really good money on the assets, and that's just incredible. But if we compare this 30 million and annualize it and compare it to the market cap of about 1.7, that puts us at about a 7% earnings yield. So even though the bank is making really good money, we have to pay a higher stock price to get those earnings to where then, we as shareholders are only earning 7% of our investment in their earnings. And that's pretty low compared to, we can go buy several banks right now that are yielding somewhere between 9 and 11%. So, do we want to pay a price that yields us 7% when we can go and buy something with the same risks or for 9 to 11% yield? So we'll just have to go through the risks and see if the risk, if we could say that we're a lot more comfortable that these earnings are sustainable and will continue into the future, then we might be willing to pay a higher price for the stock for that comfort and safety, right? But if it turns out that the risks are just normal or elevated, then we want to pay a cheaper price for the bank because we're not as certain that these earnings are able to continue into the future. Anyway, so what we have here is a really good profitable bank, but it's also pretty expensive to buy these earnings. So let's dig in and see if we can learn a bit more and decide whether we want to buy it. So this reiterates a little bit about what we discussed at the very beginning. 97 branches, most of them in West Virginia and Kentucky. The name of the bank is City National Bank of West Virginia. They bought Citizens Commerce Bank shares last year in 2023. So they're in March, so they're discussing it here, and I believe they've got a table in it, yeah. So they recorded a lot of the goodwill out of that, so $40 million. So if you consider that they bought the bank for $61 million, and it's pretty small compared to the whole thing. It's basically about 10% of its market cap, something like that. So a really small bank relative to City Holding Company. So it doesn't really have that much of an effect on the net assets and earnings and stuff like that. But one of the things we usually look at is like, okay, they paid $61 million for the bank, and there's $12 million of identifiable assets here, and net assets at fair value. So that means they basically paid a price of 3 times the net assets. We still count the core intangible here as an identifiable asset. So basically they have $20 million of identifiable assets, and they paid $60 million for them. So that's a multiple of about 3 times. And that's a pretty high multiple. Like I said, it's not a big percentage of their bank, so maybe not that big of a deal, but they did pay a pretty high price for that bank. So hopefully that turns out to be a good investment. But I would think, as me as a shareholder, I would have rather had a distribution for that amount, and then I can go buy my own bank, right? But maybe there's some synergies that come out of getting into Kentucky, and maybe it's a super good performing bank, but it's a small amount of things, so nothing to concern, and we can maybe keep going on. So the first thing is the investment. So they had some securities we saw on the balance sheet. As is the case for most banks, most of them are mortgage-backed securities. About $1.1 billion, which is 82% of the securities portfolio. So most of the risk is, or most of the securities portfolio is riskless. We got some private label, but not a whole lot there. So the other 15% is munis, as well as a few corporate trust preferred securities. So there could be some credit risk there, but I believe they discussed down here that they haven't made a reserve. Yeah, so no credit-related impairment losses. And they feel like there should be no allowance, etc., which is pretty common. Most banks don't have an allowance on their, or a very large one anyway, on their securities portfolio. We can also see the term structure of the securities, and we can see, as is the case for most banks, Most of them mature at least 10 years from now, so that's not uncommon. It's a risk for us in that we will be in the interest rates that they're yielding currently for at least 10 years. And if interest rates go up, then we're missing out on that, right? And the value of the securities continues to go down, which is the case for most banks right now. It's a big unrealized loss in securities because of the interest rates going up, but they've been trapped into lower interest rates for more than 10 years, right? So not uncommon, but just something to realize. It is nice though that from looking at the income statement, maybe the securities that they have on their balance sheet are yielding higher than what the typical bank has on their balance sheet right now. So that's great. And so let's keep going. We've got the loans here. So it looks like the biggest loan type on the balance sheet is residential real estate mortgages, 1.8 billion. That's about 44% of the loan portfolio, which is a really high amount. I mean, most banks we see are somewhere between 15, 25%, something like that. So 45% is a really high allocation. And as we've seen with other banks we've looked at lately, the ones that have a high allocation to residential real estate have a much lower yield on their assets. And you can picture the 3.5% 30-year fixed rate mortgage, something like that, right? Or they could be mostly adjustable rate mortgages, but still like really low yields compared to more commercial type loans, right? And this might be why we saw in the income statement that their loans are yielding a lower amount than what we've seen over the past, over looking at this quarter for several banks lately. And the next biggest one is commercial real estate. So if we add up these ones related to commercial real estate, then it's about 35% of the loan portfolio, which is pretty average. That's what we see for most banks, somewhere around 35%. Multifamily is about in the pretty average normal range as well. So the C&I is a little on the low side compared to most banks. So this bank is a little more allocated toward residential loans than most banks, and so that would influence its yields, lower yields for residential mortgages, but also lower risk, presumably. I mean, the regulatory ratios put basically a zero multiplier on residential mortgages for the risk adjustment. Anyway, so hopefully we see a little bit of that. Can maybe see the yield on those loans when we get down to the MD and A. We'll also look at the credit risk right now. We can see what the past dues, non-accruals, all that type of stuff is. So allowance for credit losses currently about 22.3, and that's about 0.54% of loans, and that's really, really low. They've reserved for about half the percentage of loans of what we would see for most banks. So it seems like there could be a chance that they haven't reserved enough for loan losses. I mean, I'm not sure if I've seen a reserve that low lately. Basically 0.54% of loans is really, really low compared to how much of the loans most banks have reserved for. I mean, we see usually somewhere between 1.10 and 1.25%, so this is 0.54%, so more than half of a reduction, or less than half of what we normally see. So let's see how the non-accruals, past dues, classified loans look. Let's see if maybe that makes sense. All right, so we've got about 10.8 non-accruals, which is a pretty low amount. It's 0.26%, so that's really, really low. 0.26% of loans. So a very small percentage of loans are non-accruals currently. And then as far as the past dues go, we've got 6.7 plus the non-accruals. So that comes to 17.5 million, and that's pretty low. That's about 0.43% of loans. We normally see somewhere between 0.5 and 0.85%, so a lot less past dues as well. Looks like there were no TDRs as well, so no modifications to the loans. That's a good sign. Now getting into the classifieds, so we're looking at the ones that are substandard or doubtful. These have a well-defined weakness and it jeopardizes the liquidation of the debt. It's likely that they will sustain some type of loss if things aren't corrected with the borrower. So they sort of put this together a little bit tough to follow. It's like, okay, here's the individual C&I this year, last year, and then commercial real estate, 1 to 4 family this year and last year, so on. Anyway, so if you add up all the substandard for all of them, it gets us about 92 million of loans that are classified, and so that's about 2.25%. That's really, really high. I mean, we would typically see, it's basically about double, almost double what we would normally see for a bank. So they've got about 2.25% of their loans are classified, and a lot of it is, so the commercial real estate is about 4% of the commercial real estate loans are classified, and that's more than double what we would normally see. And then on the C&I is about 7% of their C&I is classified, and that's maybe triple what we would normally see for most banks. So there's something in their loans that are making them substandard, and the 1 to 4 family, which is where they're mostly allocated toward, is almost 0% classified loans, which makes sense. So even though there weren't any, or not a very large amount of past dues or non-accruals or non-performing loans, they do have a lot of classified loans here. And in the face of the reserve being half of what a normal bank's reserve is, but the classified loans are maybe more, almost double what we would see for normal banks. That really makes me a little bit cautious about the credit risk of the bank. So if I took a percentage of the reserve compared to the past dues, it gets about 127%. So they've got a reserve that covers 127% of the past dues, which is low. It's about half what we would typically see. And then compared to the non-performing loans, which would be the past dues plus the non-accruals plus OREO plus 90 days in accruing, the reserve to that ratio is about 206%, which is also really low. We would normally see something between 250 and 450, but they've got about 200% reserved. So that leads me to believe that they're a bit under reserved for the credit risk in the portfolio. And it's not necessarily, I guess you could make the case that the classified loans are too high and that presents some credit risk, but it's really not falling into the portfolio just yet with past dues or non-accruals. So whether or not that creeps in at some point, I think is a risk to us. But also the reserve they have in place is really, really low, I feel like, to match that particular risk. So anyway, there could be a point in the future where they would have to increase the provision. So if the reserve is half what a normal bank's reserve is, they would have to double the provision. The provision's about 22 million, so they would have to add another 22 million. And then depending on in the future what happens with the classified loans, they might have to add more. but I feel like they at least need to get it up to an average amount, right? So, adding 22 million expense to the income statement might not be a whole lot of money. I mean, this quarter itself, they made 30 million. So it wouldn't, I think, significantly affect the net income if they had to do that, but we're already paying, if we were to buy the bank, we would already be paying a multiple that only gives us a 7% yield on earnings. So if they had to add a provision that decreases the earnings, then we would be even yielding even less, right? So that's our risk. If I'm going to pay a price to yield 7% on a bank, I would want all of the risks to be, muted to almost nothing, right? But in this case, we've got a little bit of something that we should be concerned about. Anyway, so getting into the derivatives, they do have some fair value hedges, I believe. Yes. So about 250. So they've got 150 here and 100 here. And it's all hedging the asset side of the balance sheet, so securities and loans. So it's really not a large percentage of the securities and loans. 250 million out of, about 5.5 billion securities and loans. So it really doesn't affect our income or balance sheet that much, but something to think about. So they have taken the position of these derivatives and the direction that I don't like, I guess. So they're essentially fixing the interest rates that they're earning on the asset side, so loans and securities. So if interest rates were to go up, they don't get to participate in that increase in yield, right? So I usually prefer the fair value hedges to be on the liability side, where they fix the interest expense yield, especially in this environment where the yields in the market are higher than what is shown on this income statement, right? So if we allow the assets to reprice, then they'll be repriced at rates that are higher than what the income is here, but they've fixed those rates and don't get to participate in that. Anyway, like I said, it's not a big amount, 250 million out of $5.5 billion of assets, but still something to consider. And we'll look at it in the more of a grand scheme of things later on to see when's the repricing of all the assets, when's the repricing of all the liabilities, and how the derivatives enter into preventing that repricing at certain times, right? So anyway, so they've got some stock-based comp here, which doesn't amount to a whole lot outstanding, 131,000 shares, which is a really small amount compared to the 14 million shares they have outstanding, so not a big risk for dilution. Commitments of 245 million plus 3345 plus 62. That's not a whole lot either. It's about 16% of the loans. We typically see somewhere between 22-28%, something like that, so nothing to be concerned about. Now we're down into the fair value measurements. So usually compare the carrying amount, basically what it is on the balance sheet, to the fair value amount, and make any adjustments to get all the assets and liabilities at a fair value. And then we can sort of do price to book ratios using fair value, or capital adequacy ratios like common equity ratio that's traditionally used, but use them at fair values rather than the balance sheet value. And so when we do that, our assets decrease by about 180 million, so from almost 4.1 to about 3.9. And there's only available for sale securities, so we would only do this for held to maturity securities, which they don't have. So the loans decreased by about 180 million, which is about 26% of the equity. It's a pretty small amount. so not too bad. The big thing that's different about this bank in comparison to other banks, typically there's nothing to adjust here, or at least a very small amount in the deposits, because they're so short-term duration that there's generally not a large difference between the fair value of them and the carrying amount on the balance sheet. But in this case, there's a huge difference between fair value and carrying value, and it's about $277 million difference, which is about 40% of equity. I mean, there's only maybe 2 or 3 banks in our entire population of about 340 that have such a big difference in fair value and between the balance sheet and fair value. So it leads me to think that, well, I guess the only possibility could be that there's a big difference between the market interest rates of deposits in the market and what the bank is paying for the deposits here. And we did see on the income statement and the expenses that the deposit yields are super low, right? So that makes it a whole lot more valuable to the bank. Basically, the value of those deposits are lower, but a lower liability is more valuable to the bank, right? So they're paying a lot less for those deposits, and maybe it's the case that makes this make such a large increase to the fair value of the equity of the bank. Anyway, so putting that all together, and also subtracting the intangibles like the goodwill and intangibles, puts the tangible fair value of the net assets, so assets minus liabilities, puts it about $600 million. But the bank's market cap is about $1.7 million, right? So we would be paying $1.7 million, or billion dollars, $1.7 billion for tangible net assets at a fair value of $600 million. And so that's a 2.74 multiple. That's really high. I mean, most banks, somewhere between 1.5 and 2.5 times right now, the price that you would pay for the tangible fair value of their assets. So this bank is trading at 2.75. So investors are willing to pay a lot for these net assets. And perhaps it is to buy these deposits, right? Which are somehow the bank is able to have really cheap deposits. And so then, taking the perspective of capital adequacy, we can also use this to compare the tangible net assets to tangible assets, right? So $600 million is the tangible fair value of its assets compared to its assets, and that results in a 10% ratio. And that's really high. I mean, that means their capital, especially at fair value, is a lot more robust than most banks. I mean, most of the banks we see, it's somewhere around 5 to 6% for that ratio. So this bank has about double the capital in place, even at fair value, than what most banks are. And most of it is due to these very cheaply priced deposits, I suppose. So one thing to think about is like, well, what would happen if we made the difference between fair value and carrying value not be so different? And if we did that, it would make the market to tangible fair value, we had 2.74 times. It would make that now be 4.94 times, because we don't have as much equity increased by the decrease in our liability there, right? So you'd have almost a 5 times multiple if the deposits were the same as what it was carried on. And then your tangible fair value of assets would be about 5.74%, which is in the normal range. So the capital adequacy is about the same as the average bank, aside from this huge difference between fair value and carrying value on the deposits. And you'd also be paying a very high multiple for these net assets. All right, so let's keep going. We've got the MD and A here. And you can see here some of the statistics we've already kind of calculated on our own, and discussed a little bit. So the return on assets 1.92%, return on equity 17.3%. Yeah, those are really, really good ratios. And then equity to assets, it's a really good ratio as well. So it's a really good profitable bank, but also perhaps pretty well capitalized. So looking at the net interest income, we can maybe see a little bit what are the yields. And all right, so we've got total interest earning assets 5.33%. It's pretty average. You can see the loans 5.81%. That's actually a pretty good yield. They do have a lot of residential real estate loans that are earning less than 5%, which is kind of on the low side, but actually not as bad as I might have expected. So, the loans are yielding pretty average amount. Securities are yielding more than what they are for other institutions that we've seen. So, we usually see around 3% or so. So 3.87, that's a really good yield on those securities. Anyway, it puts them at about an average interest income. So then coming down to the liability side, yeah, so we can see the deposits are earning about 1.8%. That's just, and then 0.73% for the savings accounts. So that's just incredibly low. And even the debts here, the time deposits, repurchase, and FHLB advances, those are really pretty low as well. So the bank has somehow figured out how to get really low funding sources, and so that's giving them an astronomical net interest margin, 3.95%. We would typically see somewhere around 3%, so 3.95% is way up there. Make a really good money on the net interest income, primarily from the liability side of the balance sheet being cheaper than for most banks. So they talk a little bit about the credit losses here. I was hoping they would talk a little bit about more of the specifics of the credit quality and stuff, but they don't. Alright, so let's look more at the risk management stuff. So here we've got the interest rate risk. So it looks like that, so changes in net interest income for changes in interest rates here. It looks like no matter which way interest rates go, they have less net interest income. It's pretty uncommon to see. Normally you'd see some kind of asset or liability sensitivity. We do our own calculations for this too based on the call report. And so we'll see, what's the repricing timing of the assets compared to the timing that the liabilities reprice. Of course, over the long term, a bank is naturally liability sensitive, right? Because they're borrowing short-term money and investing it in long-term assets like loans or securities. So, I usually prefer to see more of an asset sensitivity on the short term, just for that risk, right? And so looking at the repricing of when do the assets reprice in the next year and when do the liabilities reprice in the next year, and sort of make an assessment of is the bank more asset or more liability sensitive, and how does that compare to the way that other banks are situated on a asset liability standpoint. So thinking about the securities, as we would expect, most of the securities are repriced at least 5 years from now. 40% of them reprice longer than 15 years from now. So we're really trapped into the current yield on those securities for at least 5, 15 years, and maybe farther. So fortunately, their securities yield a pretty good amount compared to what we've seen at other banks. So it's not like we're trapped into a really, really low interest rate, although, we don't know what's going to happen 15 years from now. And it would be really bad to be trapped into 3.87%, whatever it was. And in the future, securities are yielding 15%, right? So we would have huge losses in the securities portfolio. Anyways, so, as we would have expected, there's not a whole lot of quick repricing in the securities portfolio. So then we usually hope that maybe the loans reprice sooner, because that's the larger dollar amount asset on the balance sheet anyway. And so I think that's the case here, because we see that about 38% of the loans reprice within the next year, which is a really good amount, because we typically see somewhere between 25 and 35% reprice in the next year. So I think we'll see next year a lot of the loans reprice into higher yields, and perhaps that means more interest income for the bank, which will be good, because we saw that interest income, at least for the loans, maybe it's in the average range, but maybe a little bit on the lower side of the average. So it'll be nice to get some repricing and higher yields there. But on the liability side, as we would expect to see, more likely, most all of the liabilities reprice pretty quickly within the first year, although we exclude the non-interest bearing deposits because they don't have interest to reprice, right? There's a risk that they can migrate into the interest bearing accounts, especially right now, as a lot of customers are doing that, but we sort of, take that out. But so as it is, the amount of core deposits, so money market savings, plus the time deposits that mature within the next year, is about 67% of the liabilities, which is actually a pretty low amount. So I mean, not really low as a whole, but compared to most banks out there, that's a pretty low percentage of liabilities that reprice in the next year. So that's great. They also have 27% of their securities deposits are non-interest bearing. So, and that's a lot more than we normally see. We typically see 20, 25%, something like that. So they've got a lot of deposits that don't mature or that don't reprice soon. And from the debt side, most of the debt reprices within the next year. This is the repurchase agreements they have on their balance sheet. The FHLB borrowings, I think, reprice a little later, somewhere between 1 and 5 years. Anyway, all that to say is that they have a lot of loans that reprice within the next year, but not a lot of deposits or that compared to the average bank. But the deposit rebalancing in the next year really puts them in a good position to maybe get some higher yields that would help offset some of the increases in yields on the deposits. And somehow they currently have deposits that are a lot cheaper than those of the average bank. So does that mean at some point these deposits are going to get more into the true market yields? And I don't know. Anyway, to kind of put all that into a summary, it seems like their interest rate risk is reasonable, especially when comparing it to the interest rate risk of other banks. It's basically pretty average compared to the way that other banks have their asset liabilities structured and the timing. So I feel pretty good about the interest rate risk. I mean, I think that they are probably a little bit liability sensitive. So that would mean that there could be a risk that the net interest income goes down a little bit, but it's not a higher risk than what would be in any other bank. So I feel pretty good about it. Liquidity and capital resources. They talk a lot about the ins and outs of the cash flow and FHLB borrowing. They've got the ability to borrow $1.5 billion from other external borrowing facilities. That's a pretty good amount. We do our own calculations around this as well. So, on the balance sheet, they had about $319 million of cash, which is a pretty average amount. And then only about half of their securities are pledged, so they've got the other half that they could use to pledge to get more borrowing capacity or to sell or whatever. So we consider the cash plus the unencumbered securities as on-balance sheet liquidity, and they've got a really good amount of on-balance sheet liquidity, about $1 billion. So that's about 20% of deposits, and that's above what we would typically see for most banks. We normally see 12 to 18%, so they've got about 20% of deposits covered by on-balance sheet liquidity. But also they have the ability to borrow more from the FHLB or even pledge more loans to borrow from them as well. And that percentage, if we were to add the on-balance sheet liquidity plus the off-balance sheet liquidity, which would be the amount that they could borrow from FHLB, it puts them in a position to where they have access to about $5 billion that they could use or borrow, and that's almost 100% of their deposits. So it's practically 100% of their deposits. So that makes me feel really good about the liquidity and capital risk. And if we come down here to the regulatory capital ratios, they've got fantastic regulatory capital ratios: 16.2 common equity tier 1, 16.7 total capital. So, and those are above what we would see for most banks, and for some of these, basically double what their regulator requires them to have. So really good capital position, really good liquidity position, it seems. And also, they basically got no brokered deposits. And that could be part of why their deposits are relatively cheaper, have lower yields. They don't have any brokered deposits, which costs a little bit extra for the broker, right? But there would be something else that causes them to be cheaper than that. So, but uninsured deposits about 14%. That's a lot less than what we would see for most banks as well. So the deposit side is really robust, but they've also got a lot of liquid assets and the ability to borrow from external sources. So really good liquidity capital position. Then they've also got a share repurchase program in place, about 960,000 shares that can be purchased, and that's almost 7% of the shares right now. It's about 6.5%. So that's basically double what we would see for most banks to have approved to buy shares. So they've got the ability to buy a lot of shares, and they have the cash to do it, right? So that would help shareholders for sure. Anyways, we've sort of gotten to the end of this, and so we can maybe summarize a little bit of our conclusions and analysis and determine whether this is an appropriate bank to buy or not. So we saw that the bank is a really profitable bank, really high performing bank, and mostly because the liability side of their balance sheet is so cheap. They're able to access funding sources for really cheap, principally in the deposits. The deposits, I think, are only yielding something like 1.25%, 1.25%, something like that. So it's incredibly cheap right now when we see at least typically 2.5%, 3% at least for most banks this quarter. So that's making them have a really good net interest income. And they also have a really good non-interest income and also cheap non-interest expense. So they hit all the right pillars to give them a really good net income, and it's a return on assets of about 1.88% or so, and that's just incredible. It's basically double what we would see for most banks. So they're really earning really good money on the earnings, but or really good money on the assets. But on the flip side, the market is also requiring us to pay more for those earnings. So most banks, the earnings yield will be somewhere between 9 and 11%, but this bank, currently the market is priced at about a 7% earnings yield for this bank. So you would pay to buy a 7% return in earnings, compared to, I mean, we could go out and find 30, 35 good banks right now that would earn 9 to 11%. So there would have to be something really good about this bank that would motivate us to buy this higher price and earn a lower return, for us to want to do it, right? So we see a pretty high performing, high earning bank, but also a very high priced bank. And so if we can look into the risks to see, does that price make sense? We looked at the interest repricing risk, and I feel like we're pretty good there. It might be a little bit on the liability side, sensitivity side, which is okay. Most banks are in that position currently. There's also a lot of talk in the news lately about interest rates being decreased, right? But I usually prefer an asset sensitive position, just because the long-term perspective of banks is naturally liability sensitive, right? So at least something to kind of counteract that risk. But also in the market, there's a lot of, or the market yield on these assets and liabilities is higher than what's in this 10Q currently, right? So if things reprice into those higher yields, then if it's assets, we make more money. If it's liabilities, we get squeezed a little further on the net interest income, which is what we've been seeing for most all banks lately, right? So we prefer to get as asset sensitive as possible, but this bank is generally in line with that of other banks. So I feel like the interest risk is about average, so no big deal. The capital liquidity position is stellar. I mean, they've got basically about double the liquidity than most banks do. A really good general capital position, and a really good amount of equity compared to the assets, but also a really good amount of off-balance sheet liquidity and on-balance sheet liquidity compared to their deposits. So, and even looking at all of the normal, typical ratios that you might see in the financial press, the common equity ratio and all that stuff, they were all good as well. So it's a really good capitalized bank, really liquid bank. They have from the deposit standpoint, there's a pretty low amount of uninsured deposits, only about 14%. They have no brokered deposits, and so really good capital position, I felt like. The only thing we noticed in our analysis that was a little bit concerning is the credit risk, the loan credit risk. As we saw, there was about 2.25% of their loans are classified, which would mean that there's an identified risk in the loans that makes it more likely that they're not going to be paid back in full. And typically, for most banks, we would see the reserve be at least the amount of the classified loans. And we would also see a certain ratio of reserve to past dues, reserved to non-accruals, that type of thing. And this bank has a reserve that's about half of what the average bank has. So there could be a potential that the bank would need to increase its reserve at some point um, to match the risk in its loan portfolio. But, that might not come to fruition either, but that's just the risk that we have. That provision increasing the reserve hits the income statement, and that's a risk to our net income, right? So putting that all together, we're buying a bank to earn, or we're looking at the potential to buy a bank that would yield us about a 7% yield on its earnings, and on that market price that we would pay, right? But then we've got some credit risk there also, about average interest rate risk, but stellar capital risk. So if I'm going to pay a price that's going to earn me less than the average bank, which would be somewhere between 9 and 11%, if I'm paying a price where I'm going to be comfortable earning 7%, then I would probably need all of those risks to be stellar or muted. I would want there to be no credit risk hardly whatsoever, and I would want it to be more asset sensitive, or at least that risk be better than the average bank. And I don't think that's what we have right here. I feel like this bank somehow its price has skyrocketed over the past year, and it seems a bit overpriced. I mean, there's not very many banks that would require a price that makes them a 7% yield, right, on the earnings. 15 times PE ratios, pretty outside the norm. And so I feel like there are other banks that earn a pretty good earnings yield, 7 to 9%, and also have the same risks that this bank does, or even, even more muted, even better quality. So I'm going to save my capital to buy those other banks. Anyway, that's my thought process on the thing. And definitely let me know if there's anything I missed or any considerations. I'd be interested to know too how their deposits are so cheap. I even went back to the 10K and read through as much as I could, and didn't really see much mention of it. So it'd be interesting to me personally to know how they've got such cheap deposits. And anyway, leave any comments that you want. I'd love to hear what you have to say, and also make sure to do your own analysis and make your investment decisions for your own purposes. This is just what I would personally do for me and my clients, but your situation might be different, so keep that in mind. Anyways, thank you for listening.